While analyzing the company's financial statement and valuation, it is important to start with a quality check of the company. Because before constructing a building without working on the base of the building, that will cause destruction. Similarly, if you make an investment plan only by reviewing its financials and skipping quality checks, you will make bad investments and lose wealth. In today's video, we'll review several companies' auditor reports and explore the auditor's opinions. Hi everyone, and welcome to RM Finance. Before diving into audit reports, it's important to first understand who an auditor is and who is responsible for appointing them. Let's illustrate this with a diagram. At the top of the company's hierarchy are the shareholders, who are the owners of the company. They appoint the board of directors. Board of directors is the governing body of a corporation whose members are elected by shareholders to set strategy, oversee management, and protect the interests of shareholders and stakeholders. Now let's discuss the audit committee. The audit committee is a subgroup of the board of directors responsible for overseeing financial reporting and related internal controls, risk, independent and internal auditors, and ethics and compliance. They are the ones who recommend and appoint independent auditors. Now let's go through the management. Management executes the company's strategy set by the board of directors, overseeing day-to-day operations, managing resources, ensuring compliance with regulations, and preparation of financial reports. The persons typically included in a company's management are the chief executive officer, chief financial officer, and other senior executives. They are employees of the company, and their compensation depends upon the performance of the company. Due to this, sometimes management intentionally alters financial reports to meet performance targets linked to executive compensation. This manipulation may involve inflating revenues, understating expenses, or misrepresenting financial data to qualify for performance-based incentives such as bonuses, stock options, or profit sharing. Such actions can mislead investors, regulators, and stakeholders, potentially leading to legal consequences and loss of trust in the company. To address the situation, the audit committee appoints an independent auditor. Independent auditors express an opinion on the fairness of a company's financial statements, meaning whether the financial statements accurately reflect the company's financial position, results of operations, and cash flows in accordance with the applicable accounting standards. Before diving into the types of audit opinions, we first discuss material misstatements. A material misstatement refers to errors, omissions, or fraud in a company's financial statements that are significant enough to impact the decisions of users, such as investors, lenders, or regulators. Errors: unintentional mistakes in recording transactions, applying accounting policies, or mathematical calculations. Fraud: intentional misrepresentation, including falsifying records, overstating revenue, or understating expenses. Omissions: leaving out necessary disclosures that could mislead financial statement users. There are four types of audit opinion: unqualified opinion or clean opinion, qualified opinion, adverse opinion, and disclaimer of opinion. First, unqualified opinion or clean opinion. This is the best type of audit opinion, indicating that the financial statements are presented fairly in all material respects and comply with applicable accounting standards. Let's go through the latest L&T annual report and find the audit report. You will get the annual report document in the Investor Relation tab. Click on it. Now search with the word independent auditor. This is the auditor's report on the standalone financial statement. Let's review it. Standalone means relating to a single entity, while consolidated means relating to a group of entities. Let's read the standalone auditor's opinion. We have audited the accompanying standalone financial statements, balance sheet, the statement of profit and loss, the statement of cash flows, and the statement of changes in equity and notes to the financial statements. In our opinion, and to the best of our information, and according to the explanations given to us, give a true and fair view in conformity with the Indian accounting standards. This type of information is called unqualified or clear opinion, where the auditor is giving reasonable assurance by expressing opinion. Now let's go to page number 518 for the auditor's opinion on the consolidated financial statement. Here also auditor is giving an unqualified opinion. Now let's start with the second type of auditor opinion, the qualified auditor's report. Qualified opinion issued when the auditor finds some misstatements or deviations from accounting standards, but they are not pervasive. The financial statements are mostly accurate, except for the identified issue. In other words, I can rely on the company's financial statement and it doesn't affect or change my decision making. I can still use its financial statement for analysis of the company's performance. Now let's discuss the third type of auditor opinion, adverse opinion. This is the worst type of opinion, stating that the financial statements contain significant misstatements and do not accurately reflect the company's financial position. It suggests serious issues with financial reporting. An adverse audit opinion is very rare. Rather than issue adverse opinion, most of the time auditor resigns. The last auditor's opinion is disclaimer of opinion. Disclaimer of opinion given when the auditor is unable to obtain sufficient audit evidence to form an opinion. This usually happens when there are significant limitations on the scope of the audit. Let us understand it with an example. Now we will go through the auditor report of Reliance Infrastructure Limited. Here, the auditor is expressing a disclaimer of opinion because the auditor has not been able to obtain sufficient appropriate audit evidence. The auditor also provided the reason for the disclaimer of opinion: company's exposure to rupees 6,503 crores. The company had also provided corporate guarantees aggregating to rupees 1,216 crore. This concludes that the company is exposed to financial risk, and I can also see litigation. Let's move to the next page. Now we will read material uncertainty related to going concern. The company has outstanding obligations to lenders, and the company is also a guarantor for its subsidiaries whose loans have also fallen due, which indicates that a material uncertainty exists that may cast significant doubt on the company's ability to continue as a going concern. Now let's conclude with the given information. The auditor has not been able to obtain sufficient appropriate audit evidence to express an opinion on whether the financial statement is free from material misstatement. So I can't use its financial statement to make any decision about whether to buy its shares or sell it. And its financial statement will not give me a true and fair view of the company. It is useless to build any research and valuation report, and it's better to look for another investing opportunity. Before investing, I recommend that you go through at least the last 10 years auditor reports to understand the quality of financial statements. This is only part of the quality check. In upcoming videos, I will cover more quality checks which will improve your investment decisions. Thank you for watching. Please subscribe to my channel for more insight related to finance topics. See you in the next video.